Episode 12. There are 12 ribs on each side of your chest wall. 12 years to double your money at an average annual return of 6%. Slow and steady, people. There is absolutely nothing wrong with that. Now, who's the greatest athlete to wear the number 12? 100% Tom Brady. But because I've already mentioned Tom on the podcast, today we need to give Aaron Rodgers and John Stockton a little bit of love. Beyond MD, episode 12. Here we go. Hello, everyone, and welcome to episode 12 of the Beyond MD podcast. I am your host, Yatin Chadha. Oh my God, what just happened there? Have you guys realized that apart from the trailer, I've never actually mentioned my name on the pod? Trust me, this is not intentional. It's actually somewhat subconscious, somewhat automatic, because I've felt that over time, my name has given myself and others grief when it comes to pronunciation. Now, this is a somewhat convoluted story that I'm going to try and keep really succinct. But my name, Yatin, it's an Indian name where the T is technically pronounced like a TH. So technical pronunciation is Yatin. A lot of people call me Yatin. A lot of people call me Yatin. I love it all. It doesn't matter. Now, one of my anesthesiology attendings from clerkship at UBC when I was in med school, he went as far as to call me Yasshole for an entire day just because he couldn't pronounce my name. Now, trust me, that made for a really, really long day in the OR. Not surprising, I did not end up in anesthesia. It's one of my sad but true stories from med school. There are many of those. I think the next worst one is probably third year clerkship. It was my OSCE. I walked into the room feeling really good about myself, feeling like a rock star, and then I put the blood pressure cuff on the patient, proceeded to take the blood pressure, and then the cuff popped off. Like, I was in utter shock. This had never happened to me before. I didn't know what to do. My examiner was in shock. He looked like he was about to have a seizure because this is probably the first and last time he's ever seen this happen. So you know how they say that the worst place on the planet to have a code blue is the radiology department? Well, now you know why. And now you also know why I didn't end up in family medicine, even though I applied to some programs, had some decent interviews, good conversations, but it just was not meant to be. Anyways, if you want to connect with me, best way to reach me is on LinkedIn. I will respond right away. You can also message me at beyondmdpodcast@gmail.com. If you want to hear more of my embarrassing medical school stories, or if you want to just connect maybe for a round of golf in the GTA, I love meeting new people. Or if you have any finance questions, I'd love to shed some light, clarify, but I recognize my limitations, and just so you know, I'm not an advisor, but I'll try to shed light and clarify where I can. All right, so for the interview today, I have my good friend, Arjun Saraf. So Arjun was born in Toronto and was brought up in New Delhi, and he's a chartered accountant by trade, and he has experience in consulting for financial institutions along with experience in personal and small business accounting and tax. Now, Arjun also has a passion for childhood development with involvement in various organizations, and he's a very, very proud father to a young daughter named Arya. Now, Arjun has been in the Mortgage Investment Corporation space with New Haven Mortgage Corporation for over 10 years, and his experience includes being a CCO and CEO of an exempt market dealer. So with that, here's my interview with Arjun Saraf. I was just going to say, it's about time, man. I guess punctuality is not your strongest suit.
Not really. I've been known to come late to a lot of things, including my own wedding.
Yeah, I can tell. You know, the other thing, dude, I think you're becoming well known for, like, I'm hearing this through the grapevine, is you're golfing a lot. Like, how many rounds of golf have you played so far this year?
It's not about how many rounds I've played. It's about how many rounds I've played well in, and that's 0.
Well, what are you shooting these days?
Mid to high 80s.
And how is that for you? Is that not good? Like, are you not satisfied? Like, who do you think you are?
I think Tiger Woods, to be honest.
Tiger Woods.
If Tiger Woods took a few mulligans and maybe a foot wedge here and there, then that's who I think I am.
All right, so you may think you're Tiger Woods, but maybe you should tell the audience about who you really are and a bit about your background and how you ended up at New Haven Mortgage Corporation.
So I've grown up. I was born in Toronto. When I was 3 months old, my family, who lived in Toronto for about 10 years prior, moved back to India, and my father started his own business there and has never left. He loves it there, and he continues to run his business. Even during the pandemic, with the ups and downs, my family, I lived in India for about 18 years and came back to kind of find myself, figure out what I wanted to do in life. My father was actually a Canadian qualified CA, which was pretty much the last thing I wanted to do. And here we are. I'm a Canadian qualified CA, and I followed in his footsteps. So, I started my work in public accounting. I've done work with banks and other financial institutions. I did consulting work with New Haven, especially on the tax side, and I saved them some money. So then they ended up asking me if I wanted to come on board, and they were working on a couple of things like starting the MIC. Mm-hmm. And of course, I was interested. It was a new challenge, new opportunity, and I jumped in head first. And here we are 10 years later, and it's still chugging along.
That's a great story. And you know what? You always have struck me as someone who is up for the new challenge, open to new experiences. And that's something I've always admired about you. So, for many people out there who haven't dug into the details behind a MIC, that the term maybe is not as intuitive as it may seem, but maybe you can just describe for us, what is a mortgage investment corporation? What is a MIC?
So a mortgage investment corporation, it's an investment vehicle, a pool of funds that are used to invest in mortgages. The fund is usually managed by a separate but related manager. It allows for people to invest indirectly into mortgages through a trusted management team. It's governed by Section 130.1 of the Tax Act, which has created this structure. A MIC directs the pool of funds into a number of mortgage investments. These are generally outlined in a MIC's offering memorandum or a prospectus document, which covers key criteria such as loan to value, first versus second mortgages, income and credit requirements. The MIC generates a yield, and after expenses such as management fees, audit fees, dividends are paid and taxed in the hands of the shareholder.
Okay, and maybe you can describe to us some of the fundamental differences between, let's say, a MIC and just private mortgage lending.
So private lending usually involves lending directly into one property, a standalone mortgage. So one of the biggest differences is your risk isn't spread out over the pool. So if a mortgage goes into default, you aren't as protected. The process around dealing with one or standalone mortgages is tedious if you don't have the proper infrastructure in place. You need to be concerned about compliance, having the proper borrower's disclosure in place, administration, taking monthly payments, renewals. In terms of pros, you're looking at more control, less reliance on an external team. You're not dealing with management fees or any type of redemption provisions that are common in MICs. Looser terms around negotiations, less structure. However, this is going to change as regulators obviously focus a little more on consumer protection in the industry. And another benefit could also be little to no overhead in terms of costs, like audit fees as an example too.
Okay, perfect. And maybe you can just give us a little bit of an overview of New Haven Mortgage and the MICs that are offered. Like in terms of, I understand you guys also offer commercial MICs in addition to residential MICs. Maybe talk about that and the geography that you guys cover. Are you basically GTA or are you Ontario-wide? What percentage of your mortgages are first versus second, the size of the funds, like the size of the mortgages, just all that basic good stuff.
So, I want to start by saying that there definitely is a benefit to investing in a MIC structure. A trusted management team, diversification across many mortgages, you have the infrastructure, you don't have the hassle of administration or enforcement. A lot of MICs set aside a loan loss reserve. They invest your money and basically have a large part of what you're investing in is who you're investing with, which makes your choice that much more important. So New Haven specifically, our focus is primarily on the residential side. 98% of our portfolio is in first and second residential mortgages. We have a small amount of exposure in some commercial properties, but given the nature of the pandemic and what it's impacted, we're happy with that investment strategy. We do not do construction loans or any type of special use or development loans. Our focus is strictly on the residential real estate market. It's what we believe in, and it's what we believe is a more secure investment strategy for the long term. We are equity-based lenders, so our focus is primarily on marketability of the property versus the borrower themselves. When we look at a property, our automatic thought is the worst case scenario. What's our exit plan? How do we protect our investor capital?
Okay, and in terms of the geography that you guys cover, like for residential, are you mainly GTA or Ontario wide?
We're 100% in Ontario.
Okay.
We did expand to a few provinces out east a few years ago,
Yeah.
but we had difficulty with the laws, especially around default. What we thought was a slam dunk deal at a 40% loan to value. And when I say loan to value, I mean 40,000 we lent against a value of 100,000 on the property.
Yeah.
Just to clarify, the borrower defaulted, and when we went to sell the property, it was done through an assessment through court, and basically the judge stripped us down almost bare bones to only recovering our principal. Now, keep in mind when you're tying up investor capital for a 4 or 5 month period during this entire process and not receiving the interest that was at least owed to us, our thoughts are that we need to focus where we're experts in.
Yeah.
And that's in lending in Ontario, which is our backyard. And there's plenty of opportunity and there's plenty of demand as there's huge residential development going on in Ontario now.
Okay, perfect. And let's just say if somebody's going to invest with New Haven and put their money into a MIC, in that fund, how many mortgages are there going to be? Because you already talked about one of the advantages of investing into a MIC as opposed to private lending, one of them being that, your risk is spread out over multiple mortgages. So how many mortgages ballpark are going to be in that fund? And then also, what's the average size of the mortgage?
So generally, as an example, we have about 400 mortgages. Now that varies fund to fund. But the general idea is what you should look for as an investor is not to be concentrated into too few mortgages. Meaning, if you have a $200 million fund and only 30 mortgages, it concerns me as an investor. Because if there's a default on one of those mortgages, it's going to have a greater impact on my shareholdings versus when you're diversified into many smaller mortgages. Now, in terms of average mortgage size, again, it really depends on the fund. But for us, as an example, our average first mortgage is about $350,000, and our average second is about $125,000. And overall, our loans, first and seconds, average out to about $250K. Now, there's funds who average about 5 to 7 million per mortgage, and there's funds who average about 50,000 per mortgage. It really depends on what type of investment they're doing. Generally, on the commercial side, you'll see bigger mortgage loans, or the development side, versus a second mortgage fund, you'll see a lot more smaller mortgages in place. Now, that doesn't necessarily mean that risk in one is better than risk in another. It really, again, depends on who you're investing with and their track record and experience.
Awesome. And just help us understand your borrowers, without obviously revealing too many details. But if I go and talk to the average person who maybe doesn't have a full understanding of a MIC and what it involves, a lot of people will think that, hold on, these borrowers have to be really high risk. But after I was doing a bit of digging, it seems like, okay, maybe some borrowers may be slightly higher risk, but other borrowers may be individuals who are starting new businesses and maybe they have a temporary hit to their cash flow and they just can't get a mortgage at a bank, or other borrowers may have already basically maxed out mortgages at a bank. So I just am hoping you can just talk us through who your borrowers are, just to give us a bit more of an in-depth understanding.
So the industry has changed a great deal. And this is what people need to understand in general. We aren't the same industry as we were 10 years ago. The stigma about private lending was high rates, high fees, and gouging. While there is still some of that goes on today, unfortunately, there has been more of a conscious effort to become more socially responsible. For us at New Haven, it's still being referred to as a good lender, being able to provide a reasonable product to individuals who can't obviously meet all the boxes required for traditional financing. Our borrowers are a variety of different people, including very well-to-do and successful people. What we offer is not a last-ditch resort. What we offer is flexibility. That's why we operate on shorter terms. We give people the flexibility a bank won't give. We look beyond the boxes and try to understand who the borrowers are. As an example, I have a highly successful real estate agent friend who owned 2 properties in Leslieville in Toronto, both valued in the 2 million plus range. He needed some time to do a home rental project and sell. We were able to offer him a product that suited his needs. He was not a high-risk borrower by any means, but a borrower who needed flexibility. He has since done the refinance and gone out to a Schedule A bank, and he's happy with the service we provided him. What we want to provide is a path to the promised land, a get back to the traditional financing path.
Okay, that makes sense. And I'm assuming each borrower who's going to approach you, like they have to go through some kind of screening process, some checklist. And I'm just wondering, like, I'm assuming you have your own standards, your checklist, but can you shed a little bit of light on that? Like, how do you actually go about screening the borrowers and make sure that they fulfill the criteria?
Sure, absolutely. I think I mentioned before, we're more equity-based lenders, so our focus primarily is on the quality of the property. That being said, we obviously do our background checks, credit checks, verify employment and identity. One of the main areas of our focus is fraud prevention. So purpose of funds is very important. Depending on the type of deal, we want to ensure comfort over the income. We see if the borrower has any tax issues, debts, or any other items that could potentially cause issues when we lend to them. Right? As an example, an HST lien on their property, it supersedes a mortgage. So we want to ensure that if we're going to lend to them, that debt has been taken care of. Again, the formula we've used at NHMC for the past 27 years and for the past 12 years through the fund is a focus on the underlying real estate asset versus necessarily the borrower, because at the end of the day, just like an investor wants an exit strategy to get out of their investment once they've made their profits, we also want to apply that same principle to exiting out of an investment with this real estate asset.
Now, maybe I want to shift gears a little bit and just get into the fun stuff. So as an investor, what kind of annualized returns can we expect? And Arjun, maybe you can talk about this kind of during average conditions for the economy, housing market, what have you, and then maybe even during conditions where there's a bit of a downturn. Like, what kind of average return can one expect?
Sure. I mean, it really depends on the fund that you're invested in. Again, if you're invested in a second mortgage fund, you're looking at a higher return. You're looking potentially at the 10, 11% return range. Now, that being said, there's obviously risk that comes with that. In the last 3 to 4 years, what we've seen is a real downward pressure on rates. So what you'll see today is private lenders offering rates at 4 to 5% versus about 5 or 6 years ago, that was unheard of. Private lenders' first mortgages would start at 8%. Nowadays, they start at about 5 or 6%. That doesn't necessarily have to do with the state of the economy, because as we know, the housing market is quite active and on a real hot streak. But that really has to do with the fact that there's definitely a lot more money in the private space than there was 5 to 10 years ago. So what that's done is it's given people more options. And what a lot of MICs are doing as well is they're leveraging lines of credit, which they're getting from the banks at 1 or 2 or 3%, and using that to lend out this money at 4 or 5% and making that spread and benefiting the investors from that. So our fund, as an example, probably about 3 or 4 years ago, we were in the 8 to 9% range. But in the last couple of years, we've been probably between the 7 to 8% range. That has a lot to do with 2 main things. One is the competition that I referenced, and 2 is us trying to be more reasonable with our social responsibility and not trying to take advantage of borrowers and giving them an actual product that meets their needs while still balancing the concerns of our investors and managing their returns. So it's a fine line. So to answer your question in terms of a downturn or a recession, we've had several upticks and downward trends in the industry over the past, I would say, 10 to 12 years. Especially during 2017, 2018, we had another streak similar to the one we're going through now, just before they announced the stress test. Now, what that had done was it pushed prices in the industry way high. And it's very important to understand that a management team during that time needs to look beyond the fact that the market is going up and escalating consistently. Because New Haven ourselves, we actually cut back our lending during this time because we were concerned about the inflation in the market, that some of the properties being offered were not really worth what they're on paper and what they're being assessed at or appraised at. And we cut back our loan to values and we introduced something called skin in the game. So it's very important that an investor understands that when looking at the underwriting criteria of a fund, they need to emphasize skin in the game, which is the borrower is invested in that property and not using their property as an ATM. Because when a borrower uses their property as an ATM, that's when they run into trouble during a downturn or a recession, because they've leveraged themselves up too high and they're going to struggle to get out of it, because once the value of the property drops, you're not able to refinance out. Now, fast forward to today, we're seeing a very similar trend in the industry and a stress test that's being announced on June 1st. So what we're seeing is an escalation in the market, and that doesn't necessarily translate into higher returns, but it does translate into more mortgages being given out. And it's very important to monitor more loan to value during this time than returns. Now, an important thing to remember about a MIC is it's not your home run hitter. It's a part of your portfolio. It's not the part of your portfolio like crypto where you can make a 400% return in a day. It's the part of your portfolio that you're looking at an asset, a traditional asset that has provided returns over the longest period of time in a manner that has made investors happy for many, many years. It may not be in the 20 to 30% range, but within the 7 to 9% range is still very good. It's better than keeping your money in a bank in a GIC.
Absolutely. And what I'm getting there is that to expect basically like mid to high single percent is a reasonable expectation. Is that safe to say in a MIC?
It is, but there are MICs out there that focus on lower loan to values that do maybe the mid single digits, so 4 to 5 to 6% in that range.
Now, this might be a bit of a naive question, Arjun, but can we expect some kind of guaranteed return inside a MIC? And maybe this is just a ridiculous question, and you can feel free to tell me, like, dude, there are no guarantees in life. Stop dreaming. Or maybe it's as simple as, yes, absolutely. It could be like a low single digit guaranteed return. But are there guaranteed returns, or is that too strong a word?
Guarantee is always too strong a word. We and the regulators also have picked up on that, and there's a real conscious effort by the Securities Commission to remove words like stable, guaranteed, because what it does is it misleads investors to think that nothing could possibly go wrong with this type of investment, which simply isn't true. The housing market is cyclical. There will be downturns in the future. There's not a doubt in my mind that there will be, but there will also be upswings in the future. The key is finding a team that can manage that. Now, saying the word guarantee means that nothing can go wrong with the investment strategy, but that's simply not true. What we could do is, there's no such thing as a guarantee in life. I mean, you touched upon that, but you can do everything in your power to ensure the highest rate of return with the smallest amount of risk. And that's where the balance comes into play. There's always and will always be risk.
Now we'll get back to the interview in just a moment. I want to take a quick second to thank everyone for tuning into the podcast. The feedback, the support I've been getting is definitely more than I expected, and it certainly gives me all the motivation I need to continue learning and to continue pumping out episodes. So thank you to everybody. And some of you have also been emailing me with topic suggestions, and I love those emails, so please keep them coming. And to those of you who've taken the time to leave me a rating or review, you have no idea how far these actions go in spreading the word of the podcast. So for me, that is greatly, greatly appreciated. So if you want to get a hold of me, LinkedIn or beyondmdpodcast@gmail.com.
So let me ask you a question, since you've asked me so many questions on the pod.
You know, you're the first guest. You're the first guest to, in fact, ask me a question on my own pod, but that's supposed to be a good thing. So go ahead.
What would you say is your goal with this podcast? Like, where do you see yourself in 5 to 10 years while doing this podcast?
You know, that's a really good question. I think I have definitely near-term goals and then maybe some longer-term goals. But for the short term, anyways, first off, the reason I started this podcast was, in fact, to just try and kind of bridge the gap. Because, you know, to be honest, and this podcast does not only apply to doctors, it applies to really anybody who has an interest in their own personal finance. But one thing I found is, you know, when you're training, when you're getting ready to start your career, there are so many moving parts. And I find that it's really easy for personal finance to kind of fall by the wayside. And then when it comes time to making these critical decisions, like do I incorporate, when do I incorporate, what do I need to know for insurance? Those are some of the big questions. You know, those become very daunting topics, and they shouldn't be daunting topics. You know, I feel like we should all be equipped with the right information to kind of navigate these decisions. So, you know, first and foremost, my goal is to just put out, you know, good quality, kind of expert guided content to help others, including physicians, and again, everybody, to just navigate these really important decisions. And then in the long term, I mean, we'll see how it goes, but, you know, as I gain a bit more experience and pump out more episodes, you know, maybe one day, who knows, this could turn into something. Like, I like to write. I publish a fair bit on social media. I have my website, but, you know, one kind of loose thought I had was down the road, maybe a book when I've acquired enough knowledge. But right now, the focus is kind of quality content and just continuing to put out episodes. But thanks for the question, man. I appreciate it. So I guess it's back on me now to ask the questions. But I have to say, I really liked your answer on the last question, because when I asked you, is there a guaranteed return when investing inside a MIC, you essentially said, listen, there are no guarantees in life. So I appreciate the honesty. And my next question is, if one wants to invest inside a MIC, is there a minimum investment that one has to make? And then what size of investments are you typically seeing investors making?
The minimum investment, it really depends on the investor criteria. So there's a lot of requirements in the space, the MIC space. It's governed by shares of a MIC can only be traded by an exempt market dealer. And an exempt market dealer has to qualify investors based on certain categories. There's an eligible investor category, there's an accredited investor category, and there's a permitted investor category. And these categories are split up by essentially the investor's qualifications. So as an example, an accredited investor, to qualify, you would need $1 million in net liquid assets, meaning cash and investments. And when I say net, that means net of any related debt. A lot of investors get confused because they're like, okay, I have a house worth $2 million that's free and clear, but that's not a net liquid asset. Real estate isn't a liquid asset. So it's important that you understand what category you fit into. Now, as a permitted investor, as an example, there's not as much of a focus on it because these people have 25 million plus. So it's not really a concern in terms of how much they invest. But essentially, what's very important is to ensure for the exempt market dealers, when they're qualifying an investor, that investor doesn't have too much of their assets tied up in similar types of products or this one product. So as an example, if you came to me and you only had 100,000 to your name and you told me, "Hey Arjun, I want to invest 100,000 in your fund," I would have to turn you down. I wouldn't be able to accept your money. So there's another category of investor that the OSC introduced, which is called the eligible investor category. Now there's limitations, but what it allows someone to do is invest up to $30,000 per calendar year. There's assumptions I'm making with this example, but all things held true, there's $30,000 per year that they can invest in our type of investment, which is a MIC. Now that would mean that they would need to qualify as an eligible investor, which would mean that they would need either $400,000 in net assets or $75,000 in income for the past 2 or 3 years individually, or $125,000 combined with a spouse. So when you ask me that question, it's not as straightforward as giving you, at a minimum investment amount. The average investment that I see can vary anywhere between 100 to 500,000 in the fund. That doesn't mean we only accept that amount. It just means that's generally what we see with the investors that come to us and put their money in our fund.
Let's say if you have a young professional who's relatively early in their career and they want to diversify and partake in a MIC, then it sounds like one of the criteria you mentioned, as long as they're making a certain amount of income, they may fulfill that eligible investor criteria. Am I correct?
Correct. Yep.
Then in terms of the returns, are they paid out as dividends? Are they paid out as interest? And are they paid out monthly, quarterly? Maybe just briefly sum that up.
It really depends on the fund. Firstly, they're paid out as interest. They're taxed to you on a T5. People invest through their RSPs and their TFSAs as sheltered. So obviously the money that they earn within that is not taxable. And if you don't invest through one of those structures, so say you invest individually or through a corporation, a T5 would be generated to report the interest income you earned over however long the period of time was, up until obviously year end. And you'll find dividends really vary. So some like to pay it out quarterly. We pay it out monthly. Some people pay a fixed dividend, which we stay away from. We believe in distributing cash flow that we receive. So New Haven's dividends historically on a month-to-month basis have varied and fluctuated because we pay out cash we receive back to the investors. So we never are in a situation where we're paying dividends out of principal, as an example. Because say, you have a fixed dividend of 6% and your yield for the month is 5.5%, where are you getting that 0.5 from? You're essentially accruing it and assuming somewhere down in the future, you're going to get that money to distribute. But if you follow that philosophy, and again, you mentioned downturns or economic trouble, when borrowers stop being able to pay, that's where you run into that issue where if you've paid X amount out of capital, how are you going to recover that money? Because real estate value is down, the borrower doesn't have the capacity to make their payments anymore. So that's also a very important thing to consider.
Okay, I think there's a lot of useful info there. And you already commented on some of the tax efficient ways to do this, because tax efficiency is essentially one of the themes of the podcast. So it's nice to know that a MIC is RRSP eligible. I think listeners will be happy to hear about that. In terms of, let's say you have a longer investment horizon, Arjun, and you don't want to really, see this interest or these dividend payments right away, can you basically have these payments just reinvested into the fund in the form of like a drip? Is that possible?
Absolutely. So every fund that I know offers a drip.
Okay.
So you have the ability to do that. Now at times, so as an example, during COVID, when COVID first started, people suspended their drips because they were concerned. There was a lot of uncertainty in the industry.
Yeah.
People suspended redemptions as well. So there are times where these programs can be suspended. New Haven, we didn't suspend any of our programs. We offered redemptions. if people requested them. And we also uh, fully allowed people to participate in the DRIP program.
Okay, that's good to know. And I'll just clarify for the audience, a DRIP is a dividend reinvestment plan or program. I know I don't like acronyms, but just so everyone's on the same page. Now, I just want to bring up stocks for a second. I know what we're talking about is different than stocks, but most people I know do invest in the stock market. And one of the benefits is that it's a liquid investment. So if you have a cash need that comes up, you can just yank your money out. Easy to do. But when you're investing in a MIC, a mortgage investment corporation, what's the minimum time frame that you need to be thinking about? I'm assuming this is not really a short-term investment, but more a medium and long-term investment. Maybe just tell us, how much time do you have to have your money inside the MIC? And then if the need comes up, if you need to pull the money out, are there associated fees? Just maybe sum that up for us.
So again, this depends on the offering memorandum of the MIC. Now, there was a trend in the industry probably about 5 to 7 years ago where you would see a withdrawal fee schedule. So sometimes it would be over a 5-year period whereby within the first year, you're not allowed to redeem your investment. If you do, there's a 2% penalty. And then it would scale down from there. So in the second year, there'd be a 1.5% penalty, third year, 1%, so on and so forth up to year 5. And then it would be fully open from then. Now, traditionally, MICs do anywhere between 30 days notice to 120 days notice, depending on the investment and the offering memorandum. What more and more people are understanding is that an investment like a MIC, people tend to put their money in and they don't really need to access it all that often. During COVID, there was a couple of cases we had where, as an example, a dentist who had to suspend their practice, they needed the cash flow, so they asked for their redemption. But other than that, people navigated through the storm with us, right? And even though our returns for a period of time had decreased, they kind of came back up and averaged out over the year to what we had expected them to be, between the 7 and 8% range.
Okay, shifting gears now, maybe just to discuss some risks, because if I go to the average individual and say, what do you think about investing in a MIC? I find it to be a very polarizing topic. Like, I have people who will say, you know what, this is high risk. What if there's a bunch of defaults? I might lose all my investment. But then I actually know a few people who are very pro MIC and they are advocates for this. And they say that, listen, if the fund is managed by the right institution and the right people, there's really not too much that can go wrong. So I have commentary, Arjun, on both extremes. So it creates a spectrum for me. Now, just where in that spectrum is a MIC when it comes to risk, in your opinion?
I think that, what you really need to focus on is who you're investing with. I think that's the bottom line. Really, you're investing in the management team, the infrastructure, and the track record. Because if you notice over a period of time that performance has been, relatively consistent, then you know that you're investing in a team that's been through the ups and downs of the industry, that understand what happens in arrears situations, how to efficiently get out of arrears situations. There's quite a few factors that you need to consider when investing with the MIC. But first and foremost is, as you mentioned before, you're investing with the management team. So you need to really trust the people that you're leaving your money with. And you need to understand that the decisions they make have a direct impact on your money. And the only way that you can ensure that your money is in good hands is either by referral or by looking at their track record, right? Because people obviously want to know that, hey, so-and-so has invested with you over a 5 or 6 years period, and, they're comfortable with you, and I want to invest with you too. Can you tell me a little bit about yourself? What you also see is people will test the waters too. So what we had during COVID is people were not sure that they could get their money back. So we had a couple of investors who basically said, okay, I want to redeem my money. And we said, okay, sure, no problem. When it came time to pay the money back, they said, actually, we don't want to redeem. So they waited this whole period just to see if I would, or our team would, give the money back. And when we were ready to pay them, they said, okay, no, you know what? We don't want it back, actually. So it was kind of like they were trying to see if we had the ability, and naturally so. I mean, it's something you'd want to know, and that's something I'd encourage anyone doing their due diligence on a MIC for, is to understand, has that MIC ever suspended redemptions, and have they ever gotten into trouble? And you need to really understand the arrears portfolio of that MIC, because arrears is where the key is. That's how you know how healthy a MIC is. If a MIC is running arrears with between 2 to 3%, you should be okay. When they start creeping up over the 10%, 11% mark, you should be concerned, because at that point, it's going to start affecting your capital and your returns.
Okay, maybe just elaborate on arrears, just for the general listener. Like what does this term actually mean, and just its relevance to the MIC and when you're doing your homework.
So arrears could be broadly defined from an NSF check. So generally, what happens is a borrower, unlike traditional banks, obviously in the MIC space, because of the higher rates, there's generally a greater chance of someone bouncing their payment. So on a monthly basis, X amount of borrowers will bounce their payments. Now, if you're in a very conservative fund, like a first mortgage fund, you're generally not going to see a high rate of this happening. It'll be comparable to what the banks get. The higher rate and the higher risk that you go, obviously you're going to see more NSFs. Now, a lot of those NSFs are cured within the first month of the NSF. There's usually a payment arrangement made. There's a plan in place for the borrower to recover their mortgage. Past that, you have the power of sale situation, where a borrower is not able to come to the table and the fund initiates the power of sale. Now, when you start seeing a bunch of files under the power of sale umbrella, that's generally a concern. And if these power of sales last a 5 to 6 to 7 month period because of defenses put in by the borrower or trouble selling the property, that's where you see the biggest concern. So one of the most important metrics I would recommend is to see individual deals, how long they've lasted in arrears, in the power of sale portion. Because what that'll tell you is how quickly they're turning over the mortgages. Now, and if you have a bunch of mortgages that are sitting there that haven't turned over, that means they're not getting money and they're not being paid on, which means that how is the return, X amount if, you have X amount of the portfolio in arrears? There needs to be a justification between that, right? The return should obviously correlate to how much arrears that you have in your portfolio.
I love this information, because I was going to ask you about all these scenarios, some of these worst case scenarios, and you've kind of already provided it. But I think you've also given us a bit of a checklist. So let's say if you're an individual, an investor, you want to put your money inside a MIC, I think it's good to have a checklist of things or potential red flags to look at. And I think you're emphasizing this, which I think is pertinent information. So thanks for this. And before we wrap up, though, I just want to touch on COVID. And I'm curious at COVID. Now, everyone's talking about COVID changing the game for so many industries, but has it heightened the risk, in your opinion, when investing into a MIC? Because I see a few things. Like, I obviously see interest rates going up, and I don't know if this is going to translate into higher rates that are charged to borrowers inside the MIC. I mean, I see it as a double-edged sword. Sure, it could result in more income to the firm, the fund, and the investors, but then it could translate to more borrowers defaulting, which could present a problem. And then what if you've got an eventual housing price correction? If you have somebody who defaults on a mortgage, you need to have like a power sale that results in less money. Maybe just talk about, in your opinion, has COVID heightened the risk when investing into a MIC? I'm just curious.
There's a few statistics that are prevalent in the industry. One being the amount that Canadians saved during COVID, and the fact that they weren't spending as much money in different areas as they were prior to COVID. That being said, COVID has its risks, and I don't think anyone knows the full impact of those risks because we're still in COVID. So the measures that the government has taken in terms of, the recovery plans, all the grants that they're giving, the wage subsidy, the rent subsidy. All this money is being generated and printed from the federal government. It's got to come from somewhere, right? And that, I think, is the biggest question. How is the government going to safely land this plane that's taken off?
Mm-hmm.
And where that's going to impact a MIC is really the cost of housing and how the cost of housing is in Ontario, specifically in Toronto. Toronto these days, even for someone making 200,000 to 300,000, it's difficult to afford a proper sized house in Toronto. And you look at that affordability, is it sustainable? Now, there's two schools of thought here. There's the New York model, which, I mean, real estate is basically a rental market there. And there's a lot of property that's owned by, the very wealthy and the very affluent people, and they rent it out to others. That is slowly what I believe the Toronto market is emulating. But I think the difference between us and New York is the fact that New York has a thriving economy, whereas Canada, we're still not really there yet. We're not at a point where I'm confident in the economy in terms of the long-term decisions by the government. I think that for someone investing in a MIC, again, you need to look at the track record of the MIC. You need to look at the manager of the MIC. You need to look at redemption fees. You need to look at management fees. You need to look at how they deal with arrears and difficult situations. Because if it's not COVID today, it's something else tomorrow. There's always going to be a risk that could potentially impact the industry. And you need to make sure that whoever you invest with can maintain and manage their portfolio during that time. And that's what I would say is the most important thing to consider.
I think that's very good advice. Important just to emphasize that, we need to do our homework before getting into this. And as we wrap up, you've kind of emphasized, Arjun, that it's really critical to look at who's going to be managing the mix. So I just want to ask you in terms of, I know there are a lot of competitors in the marketplace for mortgage investment corporations, but, maybe what sets New Haven apart from some others?
New Haven has been established in the industry for quite some time. And the brothers who founded it, David and Jason Viner, they had a very simple motto that they followed. And that was the tortoise versus the hare. I don't know if I said tortoise properly.
You got it.
Anyways, the tortoise versus the hare. And it's slow and steady wins the race. Don't overextend yourself. Don't push yourself during times where you don't need to. And I think that motto has really improved and helped our management team kind of enforce and put into place the structure that we needed to have to basically create that vision and put it into effect. And I think on that side, we believe in slow and steady wins the race. And on the borrower side, we believe in the social responsibility that New Haven has, being the good lender. That is something that's very important to our president and CEO, Jason Viner. Understanding the borrowers, what they're going through, and emphasizing that it's more than just about dollars and cents at the end of the day. Mm-hmm. Every company who makes a profit has a responsibility of what they do with that profit. Mm-hmm. And I believe at New Haven, we're more concerned with making sure that our dollars that we earn are more socially responsible. On the investor side, we're really focused on our service and our protection of investor capital. We've really emphasized that over the past 11 years that the MIC has been in place. And I'm sure if you talk to all of our investors, they would be happy with the service we've provided them, the responsiveness we have, and the fact that our returns over the past 11 years have really outperformed any other similar investments that they could have potentially invested in through a bank or another institution.
Slow and steady wins the race. That really resonates with me. I love it. And finally, Arjun, any advice you want to relay to any individuals who might be considering putting their money into a MIC, anything in general?
Again, I reiterate the fact that, hey, It's your money. It's your hard-earned money. Make sure you're giving it to somebody you trust. And at the end of the day, even trust only goes so far because metrics don't lie. There's a famous saying, numbers don't lie, right? They tell a story. So make sure the numbers that you see behind the portfolio, not just the returns, because the returns can be anything, but the arrears, the metrics, who their auditors are, what type of controls they have in place. There's a whole bunch of things you can look into behind the scenes. But at the end of the day, it all starts with trust. And it kind of builds on that. And you see the track record. You see what the MIC has to offer. And then you make your decision based on who you think is best for you and what returns you require for your investments.
All right. Those are all my questions. So to lighten the mood a little bit, when are we going to play some golf?
Whenever you can free yourself up from your busy schedule. Actually, that would be after you submit the payment for this podcast, which is chocolate chip cookies, as you're well aware.
Yeah, I mean, I know, I figured that the average person would be really enthusiastic to come on the podcast for the opportunity, to get the word out there, to showcase their skill set, their knowledge base. But turns out that you came on here for cookies.
Yeah, that's pretty much it.
Well, listen. I told you that I am going to do my best to send you a shipment of cookies. Now it's called Andrea's Cookies, based out in Etobicoke. You have to actually get the order in on Instagram on time, and if you don't do it in the first 2 minutes, you usually miss out. But as you were kind of mentioning earlier in the episode, I was asking you about returns from a MIC, and you said that there are no guarantees in life. So I know you want the cookies, and I told you I'm going to do my very best, but I think the one theme of today is there are no guarantees in life. And that applies to MICs, that applies to cookies as well. So
I find it hard to believe that there are no guarantees with these cookies because you've been posting them on Instagram every week. And it just seems to me that maybe your Instagram life is a little flashier than your real life.
That's pretty good. Worthy of some cookies, I'd say. But one thing I do preach is patience. Patience with finance and patience with cookies as well. You'll get them. But thanks again, brother, for coming on here. It was really, really good to have you. And I have to say, you know this, over the years, I've picked your brain on a lot of different topics, personal finance related, and I've always found you to be really knowledgeable. And when it comes to MICs, you're my go-to guy. And I also know how busy you are. You have a new daughter. So thanks again for taking the time, man, to come on. It was very candid information and very useful.
And I just want to say, Yatin, what you're doing here is great. I think, educating the general population on financial responsibility is an amazing thing to do. And me being busy, I have one kid, you have two. So, kudos to you.
Hey, you'll get there. You'll get there. I know you will. But I appreciate that, brother. And take care, okay? We'll chat soon. All right, there it is, mortgage investment corporations. I think if there's anything that we can take away from the talk today, it's that checklist that Arjun kept emphasizing, and rightly so. And basically, if you're exploring a MIC as a potential investment vehicle, be sure to go over things like the company, its track record, management, redemption fees, management fees, and how difficult situations like defaults, arrears, and power of sales are handled. So it's important that we do our homework. And full disclosure, I am currently not invested in a MIC, but it's something that's on my radar because it does fit in nicely with my investment philosophy and my strategy. Now, one of the reasons I was so excited to pursue this topic is that mortgage investment corporations are a type of alternative investment. And when my financial journey started several years ago, it started off with things like stocks and ETFs, and I spent countless hours over 2 years looking up companies, following stock prices, and don't get me wrong, I still find the markets interesting. But the more I learn, the more I realize that there's a whole other layer of finance that goes beyond stocks and ETFs. And over time, I've realized that things like alternative investments and tax efficiency are themes that are really, really important and I think necessary to understand for a well-balanced approach. So these are themes we are going to tackle on subsequent episodes over and over. So thank you again for tuning in, and if you like what you're hearing, please feel free to download, subscribe, and spread the word. And until next time, stay well and stay savvy.